Dividend investing can be a lucrative strategy for generating passive income and growing your wealth over time, but it requires careful planning and execution to avoid costly mistakes. In this guide, we will walk you through the most common dividend investing mistakes to avoid and provide practical tips on how to make informed investment decisions. First, it is essential to understand the concept of dividend investing and how it works. Dividend investing involves buying stocks of established companies that have a history of paying consistent dividends to their shareholders. The dividend yield, which is the ratio of the annual dividend payment to the stock's current price, is a critical metric in evaluating dividend stocks. One common mistake to avoid is chasing high dividend yields without considering the underlying company's financial health. A high dividend yield may be a sign of a distressed company that is struggling to maintain its dividend payments. To avoid this trap, it is crucial to evaluate the company's financial statements, management team, and industry trends before making an investment decision. Another mistake to avoid is not diversifying your dividend portfolio. Overconcentrating your portfolio in a single stock or sector can expose you to significant risks if the company or sector experiences a downturn. To mitigate this risk, it is recommended to diversify your portfolio across different sectors, geographies, and asset classes. It is also important to avoid investing in dividend stocks with a history of inconsistent dividend payments. A company that frequently cuts or suspends its dividend payments may not be a reliable source of income. To identify consistent dividend payers, look for companies with a long history of paying dividends and a strong track record of increasing their dividend payments over time. In addition, it is essential to keep an eye on interest rates and their impact on dividend stocks. When interest rates rise, the attractiveness of dividend stocks may decrease, as investors can earn higher yields from bonds and other fixed income investments. Conversely, when interest rates fall, dividend stocks may become more attractive, as investors seek higher yields from stocks. To avoid these mistakes and make informed investment decisions, it is recommended to follow a few best practices. First, set clear investment goals and risk tolerance before investing in dividend stocks. Second, conduct thorough research and due diligence on the companies you are considering investing in. Third, diversify your portfolio across different asset classes and sectors to minimize risk. Finally, regularly review and adjust your portfolio to ensure it remains aligned with your investment goals and risk tolerance. By following these tips and avoiding common dividend investing mistakes, you can build a successful dividend portfolio that generates consistent income and grows your wealth over time. Remember to stay informed, stay disciplined, and always prioritize your long-term investment goals.